Hi guys, welcome back to this Money Control live stream. You're watching Closing Bell with me Nandita Khemka and my colleague here.
Hello there, I am Yatin Mota.
Well, Yatin, a good day of trade today. Started the week on a very buoyant note. Triple-digit move coming in on the index. In fact, we came very close to that 23,400 mark as well. After Friday's, pause. One would have thought that perhaps the recovery has fizzled out.
Yeah.
So that hasn't really happened. And of course, we have that big event of Trump's inauguration happening tonight. So there were a lot of jitters last week. We saw some recovery and that recovery has only strengthened in today's session. But looking at the broader end of the markets, Yatin, fine fettle there as well. NSE advanced decline ratio was also 2:1. So, strength. That's what we saw in the broader end of the markets. All of the sectors, barring autos and FMCG, were trading in the green today. Hands down, financials were the top movers. Bank Nifty gained almost 2%, led by a near 10% up move on Kotak Bank. You also had Nifty PSU Bank Index gaining in excess of 2%. Wipro saw solid gains after a good set of numbers in the third quarter, and so did Kotak Bank, which I already mentioned, almost 10% gains coming in there. But Yatin, quickly talk about some of the gainers, result reaction, so to say.
So a lot of result reactions, and clearly today PSU banks were reporting good numbers, private banks were reporting good numbers. So overall the entire banking pack as well as the BFSI space was in focus. We had stocks like Kotak Bank already moving 8-10%, but also stocks like Credit Access, Grameen, Bajaj Finances of the world were doing well. Idea Cellular, after the hopes that the budget might look at waiving of penalty and interest for AGR dues, that stock was up 10%. What was not doing well is SW Solar as well as Netweb post earnings as well as various announcement stocks are witnessing some profit taking. Axis Bank continues to remain under pressure. Zomato, that stock dipped nearly 8% in intraday trade after reporting weak numbers, especially to do with the quick commerce space. Kalyan Jewellers, after several days of beating, finally saw some green on the table. 6% up for that stock, which was trading close to $430. So overall, a good day of trade with advanced decline ratio almost 2:1.
And that was all about today's market action. But as we promised, we'll be getting you a big market voice on the show. So joining me is Pankaj Tibrewal of Ikigai Asset Managers, who's one of the most successful mid-cap managers in the country. Pankaj, always a pleasure chatting with you. Let me first begin by wishing you a very happy new year. I mean, we met last year. How's this year panning out for you?
Happy New Year to you, Nandita, and the entire and your team and all the viewers. I think 2025, as we all know, in the last 20 days have started on a weak note, and you have started to see a correction in the market. We are not very surprised, as we have been cautioning most of the investors across that the health of the economy is not in the best shape. And we were seeing weakness across for the last 5-6 months, but markets, because of the flows being so strong, were not responding. And finally, the crack started coming in post the second quarter results. And also when DXY and the bond yields in US moved higher. So clearly, I think there are 3-4 things to watch out incrementally this year. One, I think the household leverage seems to be very high. We were doing some ballpark numbers. In FY20, the total EMI of India was about 20 lakh crores. This is across consumer categories, which is home loan, housing loan, vehicle loans, jewelry loans, MFI. And that has actually doubled in the last 4.5 years to about 42 lakh crores is our estimate. And incomes have not grown to that extent. And hence we have started to see pressure on asset quality, especially on the retail side. We saw some glimpse on the MFI segment. Probably on the unsecured, probably we could see more stress building up as you go ahead in the year. And also the credit growth has slowed down. That would lead to earnings cut for FY26 across banking sector if it doesn't revive back. Because most of the analysts on the street are penciling in 14 to 15% earnings growth compared to 11-12%, which we are seeing today. The second important part to note is that the government capex is slowed down materially. And for the last 4 years, the government capex moved from 3.5 lakh crores to 11 lakh crores and was a main proponent of economy recovering back. This year, we have seen that till the 8-9 months number which we have, government capex is down by more than 10 to 12% compared to the budgeted numbers. And hence, we are seeing slowness and weakness across core economy facing companies and sectors, especially road, railways, defense, etc. That needs to come back, and that will be our core expectation from the budget, that growth orientation should be back again. And the third part is the balance of payment. We have seen rupee started to decline, DXY at 109, 110, and 10-year bond yield in US at 480. I think all of them are creating pressure on our balance of payment. And don't forget, for all these years, one of my biggest concerns has been that balance of payment in India is built on capital account and not current account surplus. So if anything goes wrong globally, or on the energy prices or on the commodity, we have a problem, because if flows don't come in to that extent, our BOP and current account comes to deficit. That's not the situation today, but rupee is showing weakness, and there could be pressure on corporate India, especially companies who have borrowed on the ECB side. So I think this year, I think we have to navigate with the core mind that capital protection should be the theme. I think the easy money of the last 3.5, 4 years is behind us. Market should consolidate within the 2 to 3,000 points band on the Nifty. Downside should be protected by the earnings, which should be, in my view, 10 to 12% in FY26. And probably the upside should be capped with the other global events and the local slowness on the growth side. So I think broadly we are saying that this will be a stock pickers market this year, and we need to navigate it very carefully. The capital protection should be the core, and we should be risk managers rather than fund managers.
Sure, got your point. Elaborated quite a lot on these points. But talking about the broader end of the markets, we did see some bit of correction. But the kind of run up that they have seen in the last couple of years, do you think some more froth needs to get cleared from the mid cap end of the markets, Pankaj?
Yes, Nandita, I think the froth is getting cleared if the companies don't meet earning expectation, which in my view is quite high. Accordingly, on the broader spectrum of the market, markets will punish them, because finally stocks are slave of earnings. And we need to see earnings very closely. In a slowing economy and an economy which is moving towards a fiscal glide path, don't forget that when we had our budget in July, we talked about 4.9. As the data suggests, it should undershoot to 4.7. So we probably may over deliver that. And our senses, our expectation is that the FM may gun for 4.5 in FY26. So we have a economy where you will have a fiscal glide path to 4.5%, which means at some point capex or opex will be compromised. And don't forget, we were doing some calculations that 12 states have announced welfare schemes. And these welfare schemes account for almost 1.1% of GDP, almost 3 lakh crores per annum. And this 3 lakh crores has to go out of the state's budget, which will be nothing but they will cut on capex and pump up the revenue expenditure, which is not a great thing to do. So we need to watch that welfare schemes very carefully across the different states which have announced till now, whether they actually mean to spend as they move during the year. Also, along with that, we have the Trump policies. Today, Trump will be sworn in as the president again, and markets are expecting a lot of things from him from day one. Let's see whether he bites what he's been talking about. If that happens, I think trade tariffs and all will be closely watched. The only advantage India enjoys is that India only has 4% net import share in the total import basket in US, compared to China, which is 26%, Vietnam, Bangladesh, Mexico, and so on and so forth. So we are right lower in terms of share in terms of US net import numbers. But let's watch out very closely that how US behaves in terms of tariffs across the board. So these are few things which we have to look out for, and markets will respond accordingly. And hence, our view is that this year, don't expect any spectacular returns going forward. This year should be a consolidation year, which is not bad. And many stocks which don't get into the filter of balance sheet cash flows or management qualities probably will have a tough time as markets kind of sees some kind of liquidity slowdown. And across the board, Nandita, we spoke to all the dealer distributors. I think one feedback which is coming common is that liquidity is super tight. And that's also reflected from the banking system liquidity. That's negative by 1.5, 2 lakh crores after 5 years. So keep these things in mind as you navigate the market over the course of the year.
Hi Pankaj, Yatin Mota also joining in the conversation. When you gave your opening comments, you spoke about the budget probably needs to be growth oriented. Obviously, a lot of state governments have announced the welfare schemes. Despite the fact that tax collections are slightly flattish for them. However, if you look at the central government, they have been clearly getting good GST collection, good income tax collection. In terms of growth orientation, would you mean that government needs to rationalize taxes or probably look at capex driven incentives? Do you think PLI schemes would work better? What exactly do you think the budget should address at this point in time, especially in the context of Trump swearing in, RBI probably cutting rates, and food inflation cooling off?
So very good questions, Yatin. I think what our belief is that there are two parts to it. One, if you look at the consumption side, it's clearly slowing down. And as I mentioned, the household leverage is at a very high level. And the EMI burden has increased significantly over the last few years. And government needs to give some more money in the hands of consumers to revive consumption back. And also the good part is that over the last few years, we neither have used the monetary tool or the fiscal tool to pump up the economy. And both the tools are in hand with us. What we would expect is some rationalization on the taxation, making sure that the money in the hands of consumer is higher than it was, say, a few months back. And if that happens, it can help on the consumer discretionary side and also on the asset quality of the banks with lesser defaults. So that's one part of expectation. The second part is that government should walk the talk on the government expenditure on the capex side. As we said, that government has materially slowed down and they have not even met their budgeted numbers, which we thought was presented in July budget. If whatever numbers they present this year, government expenditure should follow that. And if that happens, you will see normalcy in the economy coming back from a growth perspective. The good news is that rural is coming back very fast. Across the board, the water reservoir seems to be in a good spot. We have good Rabi season happening. Kharif was good. So rural economy seems to be doing reasonably well. The private sector capex seems to be continuing the momentum because the free cash flows of top 500 companies, ex-BFSI, ex-IT, is about 2 lakh crores in the first half. This is post-capex. So I think the balance sheets are in a very strong position and private sector continues to do the capex. Only the government capex, once it's come back, many sectors will see normalcy being restored. And I think that will augur well from an overall perspective. And last but not the least, our expectation will be, please don't do anything on the capital gains tax. The environment today is very, very fragile. Any tinkering on further on short-term or long-term capital gains tax probably may not be treated very charitably by the market participants.
That's true, Pankaj. Taxation, one of the most dreaded words, since government capex has been slowing down, does that in any, of course this was an election year, but does that in any way signal, shifting priorities for government? Because consumption, as we know, urban consumption slowdown, that has come to the fore, and FMCG companies have been bearing the brunt in terms of volume growth. Would you look at FMCG names or consumer staple names right now, as one of the global brokerages has taken a very anti-consensus call, saying that perhaps there could be a shift in priorities? Would you concur with that? or would you say that the slowdown in capex was just a one-off because of elections? How would you view the entire consumption basket now?
So I think it was probably, in our view, one-off because the priorities of the government from a growth perspective doesn't seem to be changing. But you had few important stakes elections, and I think we've seen that the welfare schemes announced by different states helped them win the election. So I think I'm not against that. What I'm saying is that incrementally, if in this budget they start to show the commitment towards capex back again, and they walk the talk over the next 6 to 12 months, I think we will see normalcy getting restored in many domestic capex facing sectors. And I think that is quite good from an overall economy perspective. And the second part is on the capex, on the consumer side. Yes, rural is coming back. The commentaries across the board seems to suggest that. And if you look at the first 8 9 months data which is available from a taxation perspective and expenditure perspective, the capex numbers are down on expenditure, but revenue expenditure is still in line with the budgeted numbers. And that's because the three important departments, which is rural, health, and women welfare, has seen an increase in terms of expenditure. So broadly speaking, I think we have to wait for the next 10 days. We'll come to know what the priorities of the government are. But keep two numbers in mind. One is the 4.5% fiscal deficit, because next year in FY27, we will have the disadvantage of eighth pay commission, where we will have to shave away 30 to 40 basis points on fiscal deficit, which will be there. So government will try to bring it down to 4.5, and the eighth pay commission will give 30, 40 basis points kind of a dilution incrementally in FY27. And the second point is on the taxation. This time, the personal tax collection looks very good, Nandita, with 25% growth. But don't forget that one-fourth of that personal income tax collection is coming from capital gains tax and STT. In our estimate, those two numbers combined will be above 2.5 lakh crores, which few years back was just a negligible amount. So market-related gains have also become a very large portion of taxation collection. And if this year markets are not as buoyant as it was for the last few years, government may struggle on the capital gains tax, and hence this investment will become a very, very important number where we have not been so successful in the last 3 4 years.
Pankaj, in terms of composition, IT has a lot of dependence on Europe, US. We have, the pharma giants also, which totally depend, on the US exports for bulk of their, revenues. With Trump coming in, talks again of, tariffs or probably disruption in the global markets. And as you rightly mentioned in your opening comment, that this year could be probably, to manage risk rather than, looking at capital appreciation or, portfolio appreciation. So in this scenario, what are the sectors do you think would fairly remain insulated? What are the themes or, the underlying things that you feel, as a fund manager should probably help investors protect their capital and probably, help some bit of appreciation or some bit of better performance versus the benchmark indices?
So, Yatin, a very good question. And the way we have divided the portfolio into 5 brackets. The first bracket is comprising of companies which have seen cycles across and all-weather management, and they have come out stronger after every cycle. So that's the first bracket. The second bracket is where we believe that there has been leadership changes in many companies, and probably the new leader seems to be promising and bringing the company back on a growth path with the basic hygiene of balance sheet cash flows being intact. If the growth comes back by the change in management, that should bode well for the company's growth. The third ones are where it is consistent leadership and gaining market share across the board. And at the expense of competition, they are gaining market share in this volatile times. That's the third bracket. The fourth bracket is the contra bet, where we believe that the market is not giving too much of importance, but we believe these are bottom prices in terms of underlying. and some allocation is warranted in this fourth bucket as well, which will include specialty chemicals, which have not done well. And yet, after 7 quarters of decline on an aggregate basis on profits for chemical sector, our expectation is third quarter will be the first quarter where we will see some profit growth emerging in a sector as a whole. So I think specialty chemicals, cement, and metals will form in the contra theme. That's the fourth bracket. And the fifth bracket is the tactical opportunity bracket or a special situation bracket, where we believe there could be special situation stocks which can give you that 20-25% upside in a very short period of time. So this is how we have positioned our portfolio in the 5 brackets which I spoke about. And all our stocks, about 95% of our holdings, will fall in either of them. And we are very clear why we are owning each of them, which falls into each of the brackets.
Right.
I don't
last
know whether
question
that
really,
makes sense.
Pankaj. Which
Whether that
bracket?
makes sense to.
No, I think.
No, I think yeah, it is fair actually to divide into 5 buckets, and you being one of the topmost mid-cap fund manager, I think a lot of our viewers also had that query as to how really are you managing your money now, and how different it is versus the last few years where it was buy anything and make returns. Yeah. Probably now things are coming back to the ground, wherein portfolio segregation, special situations, turning around sectors, and capital protection is something that people will be watching out for.
One last question really, Pankaj. Which bucket would railway and defense fall into now? Because all these stocks have seen a fairly good run, and now reports suggest that there could be an 18 to 19% kind of an uptick in rail budget. In fact, railway allocation as well. So after the kind of up move we've seen, then the kind of correction we've seen in these stocks, which bucket would you place railway and defense stocks in now? We get a lot of queries on these stocks during our live shows, so I thought might as well.
Or probably Pankaj can also talk more about the PSU stocks in general, because a whole host of them have seen a big rally and now are witnessing some bit of correction from the tops.
So there are 2 data points one should note. So railways plus defense together was about 1.2 lakh crores market cap a few years back, which is 4 years back. From 1.2 lakh crores has went to 18 lakh crores, which is 15x in the last 4 years, 4.5 years, and created huge wealth. But over the last 6-7 months, you have seen post-election that have seen about between 25 to 30% correction in the aggregate market cap. From 18 lakh crores, it has come down to about 13.5, 14 lakh crores. But during this period, when it went 15x, the profits moved by only 5.5, 6x. So clearly, there was a huge re-rating in the multiples of most of these stocks, either in defense or railways, which makes us a little cautious, because finally, the underlying customer is government, the underlying policymaker is government. So it's entire B2B businesses, and many businesses in our view, doesn't warrant such high multiples which market was giving them. So we believe that a lot of future growth of these companies are being priced already by the market in the multiples which they are ascribing them. And any bit of disappointment can lead to sharp corrections in the stock. So one needs to be very careful in which of the names you are riding upon from a PSU perspective over a period of time. So be a little careful on that side. Just don't go by the momentum. Be very careful why you're owning a company, what's the balance sheet, what's the market share, what's the growth projections being expected by the market. So I think that's something which is very important. The second part is look at the data point on the PSU banking bank. The PSU bank during the 2003 to 2007 contribution to overall profitability pool was very high, about 14-15% of the total corporate India profitability used to come from PSUs, and that was a great time for the PSUs. Then it went down because PSUs made losses just around the COVID and before that. And now that contribution is back to 12 to 13%, which means that we are somewhere nearing the peak over the last decade, 15 years. And that also data point should be kept in mind, because it's a very powerful mean reverting data point from an overall perspective. So when you look at these two, you need to be very selective in the PSU pack and the names you want to own. And our view is also that a supply of paper on the PSU side should be very strong next year, because government need to close their financing gap, which could happen because of the capital gains or STT, by slightly more aggressive on disinvestments going into FY26. So let's wait out for the paper supply also in many of these names.
All right, then that's the word. But with that, I'm afraid we've come to the end of this edition of Closing Bell. Pankaj, would like to thank you for taking out time and joining in this afternoon in such a short notice. I always appreciate chatting with you. It's always, great to have your insights on our show.
Thank you, Nandita. Thank you, Yatin, for having me on your show. It's always a pleasure.
Thank you.
Thank you.
Thank you. Thanks a lot.
Thank
with that, Yatin, we've come to the end of this show. Good day of trade. Let's see how things really pan out tomorrow. Of course, tomorrow we'll be reacting to all the announcements coming in from Trump, who becomes the 47th US president to be sworn in later tonight. With that completely timed out, thanks a lot for tuning in to our viewers. And of course, stay tuned to Money Control for all your other news and updates, and come back and join in tomorrow morning on Opening Bell as well. Thank you.